How do emotional biases ruin my investment allocation? Imagine making a decision that feels right in the moment but ends up costing you a lot more than you expected. That's what emotional biases can do to your investment plans. When you're building and managing your portfolio, these hidden feelings can steer you off course without you realizing it. They influence how you choose assets and how you react to market ups and downs. Emotional biases are different from mistakes caused by lack of knowledge. They come from your feelings deep inside, often without you noticing. During times of market chaos or uncertainty, these biases become even stronger. Loss aversion is one of the biggest problems. It makes you feel the pain of losing money much more than the joy of gaining the same amount. For example, if your investment drops by 20%, the emotional sting is twice as intense as the happiness you'd feel if it rose by 20%. Because of this, you might hold onto losing investments longer than you should, hoping they'll bounce back. At the same time, you might sell your winning investments too early to lock in gains and avoid potential losses. This pattern can throw off your entire asset allocation plan. You end up with too many risky or underperforming assets, and your returns suffer. Plus, frequent trading to avoid losses increases costs and taxes, which chips away at your gains. Overconfidence bias is another trap. When you think you know more than you do, you tend to put too much into a few investments you believe will do well. You might underestimate the risks involved and overestimate how much you can earn. This leads to overtrading and ignoring your long-term plan. During a boom, this bias makes you believe your predictions are always right, which can cause you to ignore warning signs. When things go wrong, you blame external factors instead of learning from mistakes. This overconfidence can cause you to stray from your original asset allocation, risking your financial goals. Market conditions also make emotional biases worse. When markets are volatile or news is alarming, your fear and greed take over. You might panic sell during a downturn or buy too much during a surge, both of which distort your plan. Wealth can sometimes hide these mistakes, making it harder to see how much your emotional reactions have hurt your portfolio. Over time, these impulsive decisions can lead to missed opportunities and lower overall returns. The best way to protect your portfolio is to follow a clear plan. Before reacting to market swings, take a moment to cool down. Review your short-term goals and make sure your cash reserves cover them. For everything else, stick to your risk tolerance and long-term strategy. If you're unsure, talk to a financial advisor before making big changes. Keep records of your decisions and why you made them. This helps you see patterns and avoid repeating mistakes. Remember, markets are driven by human feelings, and understanding that helps you stay grounded. Studies show that emotional biases are linked to poorer investment results. Managing your emotions through disciplined planning and professional advice can make a big difference in how well your portfolio performs over time.